Hi everyone, welcome to my channel. I'm Doris. I'm here to show you about my stock account and today's market updates. Today, the net asset of my account is 73,172.01. Today, Apple has closed up 1.87% to 173.97, and the SQQQ closed down 5.21% to 20.57. and SPY closed up 1.07% to 422.66. The United Natural Gas closed down 3.07% to 7.27. The market generally closed higher. Dow Jones Industrial Average closed up 0.67%. Nasdaq closed up 1.64%, and S&P 500 closed up 1.05%. The industries generally performed well, with tech industries continuing to lead the gains, and the auto manufacturers also has closed up 2.74%. Overall, the stocks closed higher on Wednesday, up more than 1.6% in Nasdaq. The Fed kept its benchmark interest rate unchanged and kept the possibility of future rate hikes. Fed Chairman Jerome Powell said he was not considering a rate cut at all and will remain committed to curbing inflation. The market continues to watch U.S. earnings. At 2 p.m. Eastern Time on Wednesday, the Federal Reserve left its benchmark interest rate unchanged at 5.25% to 5.5%. The FOMC statement reiterated that it would assess the extent of further tightening. The statement says that economic activity expanded strongly in the third quarter, a language that has changed significantly from the description of U.S. economic growth, as stated in the previous meetings. FOMC said that tighter financial and credit conditions could weigh on the economic activities, recruitment, and inflation, but the extent of the impact remains uncertain. Prepared to adjust its policy stance if there are risks affecting the target achievement, the Fed will consider a range of economic factors when determining the additional extent of policy tightening that may be appropriate. The FOMC statement shows that officials described a strong recent economic activity and highlighted that possible pressure on economic activity from higher long-term interest rates. The big problem facing the Fed focuses on what officials expect the economy and how they can come to conclusions that they're moving the right direction or not. A continued downward trend in the inflation and CPI index could allow officials to keep interest rates unchanged, but any accelerations in price pressures could also lead them to raise rates again. The U.S. short-term interest rate futures extended earlier gains after the Fed left interest rates unchanged, as traders bet the Fed rate interest hike is over. At a subsequent press conference, Fed Chairman Jerome Powell said the rate cuts are not considered at all, and that the Fed did not return recession into its forecast at this meeting. He said that they continue to focus on their 2% inflation goal, and prior to this meeting, that many analysts predicted that the Fed will retain the option of raising interest rates in the future until the labor market cools down sharply and inflationary pressures eased. And the market is continuing to watch the company's Q3 financial reports. U.S. stocks performed poorly in October, with all three major indexes recording the third straight month of loss. And despite the weakness in October, the market historically has been strong in November. Mike Wilson, a big Wall Street short, argued that the S&P 500 could end the longest target of 3,900, about 6% below Monday's close of 4,166.82. His pessimistic forecast is based on two reasons. First of all, the U.S. macro outlook is deteriorating despite the strong data, and the second reason is the bearish fact that the S&P 500 companies' financial performance have not been performing well overall in the companies with bigger volume capitalizations. Investors are still watching the bond yields. In the October 2023, the yield on the 10-year Treasury note broke the key 5% for the first time since 2007, raising concern about the negative impact of Fed's long-term high interest rate policy. On the economic data front, the ADP Employment Agency reported that the private sector employment rose 113,000 people in October, less than expected. Another data shows that the U.S. job vacancies expectedly climbed for a second straight month in September, highlighting continuous strong demand for labor in all sectors of the economy. The number of job vacancies rose to 9.6 million, according to the U.S. Bureau of Labor Statistics on Wednesday, up from 9.5 million revised down in August. Recruitment increased slightly, and layoffs fell. The number of job openings was above the median estimate of 9.4 million for economists who pulled off by Bloomberg. This is all I have for today. Thank you for listening. Don't forget to subscribe and see you next episode.